Home prices can rise quickly, but when housing markets weaken, many people expect prices to fall just as fast. Yet housing downturns rarely unfold that way. Instead of sharp, sudden corrections, markets often move slowly. Prices flatten, transactions decline, activity stalls. What looks like a pause can last for years. The reason lies in how housing markets are structured. In financial markets, corrections often occur quickly. Prices react immediately to new information, and transactions happen continuously. Housing markets operate differently. Properties change hands infrequently. Financing conditions shape participation, and sellers can choose when or whether to transact. Because of these structural differences, housing markets rarely adjust on short timelines. Instead, corrections unfold gradually as market conditions evolve. Many expectations about housing downturns come from observing financial markets. Stock prices can decline rapidly when investors reassess risk or economic conditions change. Continuous trading allows markets to reprice instantly. Housing does not function under those conditions. Real estate transactions occur far less frequently. Prices are discovered through individual negotiations rather than automated exchanges. When demand weakens, markets often respond through declining transaction volume rather than immediate price reductions. This difference creates the impression that housing markets are slow to react. In reality, the market is adjusting, just through different mechanisms. Housing corrections begin not with falling prices, but with declining activity. Transaction counts fall, listings remain active longer, buyers become more cautious, sellers test the market before adjusting expectations. Because each sale influences comparable pricing for the next, the process unfolds incrementally. Real estate markets therefore adjust through a sequence of small steps, rather than sudden shifts. Before moving further, it helps to reconnect with the tension raised earlier. Housing downturns take time because the structure of the market slows how quickly supply, demand, and pricing expectations can realign. Real estate transactions involve significant friction. Buying or selling a property requires inspections, financing approvals, appraisals, legal documentation, and closing procedures. These steps introduce both time and cost. Broker commissions, taxes, and fees also increase the cost of transacting. Because the process is expensive and time-consuming, participants do not adjust positions quickly. Low transaction frequency means price discovery occurs slowly. Unlike financial assets that trade continuously, housing prices are revealed one transaction at a time. This structural friction lengthens the timeline required for markets to reset. Seller behavior further extends housing corrections. Homeowners often anchor their expectations to past prices or recent comparable sales. When market conditions change, those expectations may not adjust immediately. Rather than accepting lower prices, some sellers withdraw their listings or delay selling entirely. Expired listings increase and fewer properties reach closing. This withdrawal of supply reduces visible inventory and slows price declines. Instead of clearing quickly, markets move through a period of stalled activity while expectations gradually recalibrate. Because sellers can choose when to transact, the process of resetting price expectations often takes extended periods. This behavioral dynamic is a key reason housing corrections unfold over years rather than months. Financing structures reinforce this slow adjustment. Many homeowners hold long-term fixed-rate mortgages. These loans lock in stable monthly payments even when broader interest rates rise. Selling a home may require replacing that financing with a higher interest rate and larger monthly payment. As a result, homeowners may delay listing their properties. This phenomenon, often described as mortgage rate lock-in, reduces the number of forced sellers in the market. When fewer sellers are compelled to transact, price pressure builds gradually, rather than rapidly. Financing conditions therefore act as a stabilizing force that stretches adjustment timelines. Because of these structural forces, time becomes the primary mechanism through which housing markets adjust. When demand declines, the first visible change is often a reduction in transaction volume. Days on market increase. Negotiations expand. Seller concessions become more common. Over time, price expectations adjust. Some sellers reduce asking prices while others exit the market. Gradually, supply and demand move back toward balance. The correction process unfolds through extended periods of lower activity rather than rapid repricing. For owners, this means selling timelines may extend significantly during housing corrections. Even if prices remain relatively stable initially, liquidity conditions can change quickly. For renters and buyers, affordability improvements often occur gradually. Market conditions may shift through increased negotiating flexibility rather than sudden price drops. For investors, real estate behaves as a long-duration asset. Correction timelines require patience and careful capital structure management. For the broader market, housing rarely resets quickly. Structural forces stretch adjustment periods and create extended cycles. Housing corrections take years rather than months because the structure of the market slows adjustment. Transaction friction, seller behavior, financing structures, and gradual shifts in supply and demand extend the timeline required for prices to recalibrate. Understanding these mechanisms helps explain why housing markets move through long cycles rather than rapid corrections. Subscribe for market insights. Link in description for additional analysis.